In the last 30 days, I've received countless messages from people who are willing to start their trading career after looking at the endless possibilities that these financial markets can offer. Whether your goal is to make 5K, 10K, or even 100K a month, it's all possible with these financial markets. That is why I believe trading is a life changing skill which can set you up for the rest of your life. But the biggest problem people run into is that they don't know where to start from. So, after having had multiple payouts with prop firms and finally becoming a profitable trader myself, I'm creating this course to provide you with the most value in the least amount of time possible. First, we will set our foundation right from the basics and learn a strategy that you can implement right after this video. But as most traders think that their work is done by yet, it's just 20% of the equation for becoming a great trader. The rest 80%, and this could be the differentiating factor between a winner and a loser, lies in proper risk management and a strong psychology. Because no matter how solid of a strategy you have, until and unless you have proper risk management and a correct psychology in place, it's going to be very hard for you, if not impossible, to succeed in this game. I can assure you that we got some juicy stuff in risk management and psychology part, which you would not want to miss. So with that being said, let's get right into it. First, once we open any trading chart, all we can see is these tiny rectangles going up and down. These rectangles is what we call as candlestick in the trading world. If we look into the dichotomy of a candlestick, all we can see is open, high, low, and close, which people also refer to as OHLC. Now, it's important for us to understand these OHLC because there are different types of candlestick patterns based on the relative strength, but the base of it is always OHLC. So let's head to the chart and see how OHLC applies to the candles. So first of all, let's take this up candle for example. In this up candle, price opened over here. This was the low. As we can see, this wick created. So once this candle came down to create this wick over here, this was the open, this was the low, this was the high. As candle went up, this was the high, and then it closed back down over here. If we look into this red candle, in this red candle, we had this open over here. Price went up till here. This was the high. Price went down. This was the low. And then it ultimately closed over here. So this is the close. And this applies to every candlestick pattern as you see. Like in this up candle, this was the open. This was the low, high, close. In this down candle, open, high, low, and close. Now, it's important for us to understand these candlestick patterns because they reveal a lot about where price could be heading next. So, for example, if we just have a look at open, high, low, and close, if we observe this candlestick pattern over here, for example, this candle. So, what happened? Price opened over here, wigged lower till here. This was the low. This became the high, and ultimately price closed down over. So the question that we need to ask ourselves is, who is in control over it? Even though it looks like a green candle, but who was in control over here? Was the sellers came in, they pushed price up until here, then the buyers came in, they pushed price up over here, and ultimately again the sellers came and price closed down over here. So it was a 50-50 fight between both of them. So this candle demonstrates an indecision in the markets. Price could be heading up as well and could be heading down from here as well. But the next candle, if we have a look at this one, we got a strong candle towards the downside. If you really have a look at it, we had the open over here. We had this tiny high. Buyers tried to came in, but ultimately the sellers conquered and pushed the price up until here, and price closed over here. So after looking at this candlestick pattern, what do you think? Who won over here? The buyers or the sellers? Well, it's quite obvious that the sellers won, and that is why we got the next candle towards the downside. If we have a look at over here, this candlestick pattern, like people call this as a hammer, but you don't need to remember any candlestick patterns. All you need to see is open, high, low, and close. So what happened over here? Price was coming down and down and down, and ultimately over here, price again, this was the open, price came down till here. The sellers were strong up until this point. So at one point, price was down over here, and then the buyers pushed price all the way back up to here. And as you can see, it pretty much closed very much near the high over here. So what does this demonstrate? That sellers were powerful till here, but ultimately the buyers won and then price rallied up. So if we have a look at OHLC, this in itself reveals a lot about where price could be heading in the short. But predicting price movements is not just a matter of candlestick patterns alone. There are different types of analysis which people use in their day-to-day trading, but the two most important ones are technical analysis and fundamental analysis. Fundamental analysis involves looking at the news release and its impact in the economy if you are in the forex market, or studying the balance sheet of a company to gauge a view on where price could be heading next. Technical analysis, on the other hand, involves predicting price movements based on repetitive patterns in the market. Again, if you're just starting out, there are multiple technical analysis tools, but if you're just starting out, I would recommend you to stick to the two most useful ones, which is support and resistance, also called as supply and demand. I want you to visualize support as a floor which prevents price from dropping further, and resistance as a ceiling which prevents price from going up. To better understand this, let's have a look at a few chart examples. So to identify our support zone over here, let's have a look at a price point where price struggles to go down. The very first level that becomes obvious to me is this level over here. So what we can see is price once came down to this level and went up. Again, it came back to this level, went up, came back to this level, went up. Again, it came back and went up. So this level was acting as a floor which prevented price from dropping. So this becomes our support zone. Now to identify our resistance zone, we need to see where price is struggling to go up. So the very first level that is quite obvious to me is this level over here. What we can see is every time price came back to this level, it came down. It came to this level and came down. So this level over here is acting as a resistance, which is preventing price from going up. Now, once support gets broken, it gets converted into resistance. So for example, this over here was support as long as price was above this level. But once price breaks this level becomes a resistance for price, which sends it towards the downside. Similarly, for the resistance, if the resistance gets broken down, it gets converted into support. Now, once price broke this support, our next support zone could be this level over here. And as you can see, again, price was struggling to break this level, but once it broke this level, it acted as a resistance and price rejected this level to go back down. But not all support and resistance are created the same. Some will be more powerful than the other. So the question is, how do we differentiate between high probability support and resistance levels? Well, the answer to this question lies in the understanding of different market conditions. You see, there are only three ways that the markets can move. It can either move up, down, or sideways, which is also called consolidating market. As a matter of fact, markets consolidate for the majority of time. Real money is made when the markets are trending and moving aggressively in your favor. Nothing sucks more than being stuck on the trade for hours or days without any price movements. So to get the highest probabilities in our favor, we need to position ourselves into trending market conditions. But the question is, how do we identify trending market conditions? Well, it's very simple. In an uptrend, markets create a series of higher highs and higher lows, higher highs and higher lows, while in a downtrend, market creates a series of lower lows and lower highs. But to understand this, let's have a look at a few chart examples to identify uptrends and downtrends. So if we scale down to the 1 hourly, for example, this over here was a downtrend. As we can see, price aggressively dropped towards the downside. But in the downtrend, as I previously said, we create a series of lower lows and lower highs. So this over here was the lower low. Price retraced back. This was the lower high, lower low, lower high, lower low, lower high, lower low, lower high, and this continues. This tells us that the markets are moving in the downtrend and is in the downtrend, so we should take down trades and hold our trades. While in an uptrend, to have an example. If we scroll to the left and have a look at this market over here in this up move, we got a series of higher highs and higher lows. This was the higher high, this was the higher low, higher high, and then market started creating lower lows and lower highs, which acts as a signal that now the market is shifting towards the downside. To get an understanding of consolidating markets, we can see it over here only. This price movement over here. So this was almost 30, 40 candles. And as you can see, price did not really move much. Like price was stuck in this range going back and forth, up and down, up and down. There was no real movement. Only once price broke through this level, we created this trend. And then again, we got this consolidation over here and a new trend was created. Till now, we discussed a lot about technical analysis and how you can use it to frame high probability trades. But if you don't decide properly the vehicle you use to exploit the markets, you'll still be left in a state of helplessness where you find it difficult to extract consistent profits from the market. By the vehicle, I mean the type of trader you wish to become. So basically, there are three types of traders. Number one, it's a scalper who trades in the lower time frame like the 1 minute or the 5 minutes, and they hold their trades for a few minutes to max and up. Next is a day trader who trades in the 15 minutes or the 1 hour day and hold their trades for one day, but they don't hold their trades overnight. And the last type of trader is a swing trader who trades in the higher time frame like the 4 hourly or daily and hold their trades for days and sometimes even weeks. Now the vehicle, aka the type of trader you wish to become, depends completely based on your personality. There's no right or wrong answer. If you're a quick decision maker, you can go with scalping as it demands you to take decisions and actions quickly. But if you're more of a calm person who does not love fast-paced trading, then you can experiment with swing trading. And if you're someone who can't hold their trades overnight, you can experiment with day trading. The biggest mistake people make is see someone make money with a particular style of trading and they instantly try to copy it. What they don't understand is no matter how precise the strategy is, if it does not align with your personality, you won't make money from it. It just does not align with your personality, so there's no point to learn that style of trade. It's all a waste of time, energy, and effort. So if you want to save yourself multiple years of trying and failing, I would recommend you to take this decision very wisely before you learn any style of trade. But if you ask me the strategy I use on a day-to-day basis, which has helped me to generate consistent withdrawals from the markets every single month, I have broken it down into a 5 simple step process which can be used by anyone. The first step in the process is to identify our support and resistance levels in the 4 hourly. Then we look for 4 hourly rejections in these zones. Once we get those rejections in the 4 hourly, we scale down to the 1 hourly to look for our entries. For our entries, we are simply looking for a break of a consolidation and our stops goes above or below the high and low. And for our targets, we are simply targeting for 1:2 risk to reward ratio, which essentially means if we are risking $100 on a trade, we are aiming to make $200 on that trade. So to better understand this strategy, let's head over to the charts. First of all, our first step was to identify our support and resistance levels in the 4 hourly, which we already did in the technical analysis part. All these levels over here are acting as our support and resistance levels. Then the next step is to look for rejections in this level. So for example, let's take the price action of 2nd of September over here. Once price came to this resistance level, we got this rejection with a red candle indicating that price is struggling to break above this level and this level is acting as a resistance level. Then we scale down to the 1 hourly to look for our entries. And if we scale down to the 1 hourly, what we can see is we got this consolidation over here where price was stuck in this range for quite some time. And then our entry, as we said, was at the break of the consolidation. So as soon as this consolidation breaks, you can enter over here or you can wait for the close of the candle. Let's say you waited for the close of the candle and entered over here. Your stop loss would be above the high over here and our take profit, as we said, goes to a simple 1:2 risk reward ratio, and then price aggressively drop down to hit our take profit. Now, I'm not cherry picking these examples because this strategy in itself does has losses like every other strategy. It does not guarantees you to make money every time. For example, like we also identified this level as our support zone, and once price came to this level, we got all these rejections. So after these rejections, we scaled down to the 1 hourly based on our plan. And if we scale down to the 1 hourly to look for our entries, what we can see is we got this consolidation, and at the breakout, if you waited for the candle close, you could have avoided this loss over here. But let's say, like in the worst case scenario, let's say you're entering right at the break of the consolidation, not waiting for the candle to close. If you entered over here with the stop loss below the lows, you might would have got stopped out of the trade. And it's completely fine. You lost 1% over here, but if you stuck to the strategy, you would have made plus 2% over here, making you net positive for the day. So that's the point. Like every other strategy, this strategy also has losses, but if you follow this strategy on a long enough time horizon, you will be net profitable. Now, if you want to learn this strategy in a more detailed format, I created a separate video about it in my previous video, and I also took a live trade using the same strategy at the end of the video. So you can check that out. And I've also just launched my Telegram channel. So if you want to learn how I consistently apply these concepts in the live markets, because education is one thing and application is completely another thing. So if you want to learn how I apply these concepts live in the markets, you can join my Telegram channel. It's completely free, and I will provide a link for it in the description as well. Now getting to the next part, which if not done correctly, can set you in a negative cycle of making money and losing it back to the markets, even if you have a winning strategy. I will go as far as to say that risk management is even more important than the strategy you trade. But before we dive into risk management, let's have a look at a few mind-boggling stats of the trading industry. According to the 1990 rule, it is said that 90% of traders lose 90% of their money in the first 90 days. Can you imagine how easy it is to win in this game? The barriers to mastery has never been so low. I mean, we are talking about being in the top 10% just by managing your risk and making sure that you don't lose the account. Even if you are at break even after 90 days, you are well above the 90% of traders. Even with the worst strategy ever created, if you manage your risk properly, it's impossible for you to blow an entire account in 90 days. That is why I go to say that risk management is your path to trading profitability. But the question is, if it is so easy to stand out from the crowd, then why do 90% of traders keep losing? Well, this is something we will discuss in the psychology part, but getting back to risk management, the position sizing you use varies from one instrument to another. This is why I recommend you to use a position size calculator, and this tool alone can help you from so many blown accounts. And the best part is, it's completely free. So use these tools to your advantage. Now, talking about the risk percentage, again, it varies from one individual to another, but I would recommend you to risk no more than 3% of your account on one trade. Again, it all boils down to losing an amount that you're comfortable losing. But if you're just starting out with a 3% risk, it will take you almost 33 consecutive losses in a row to lose your account, which is very unfavorable, if not impossible. Now, getting back to our previous question, which is why 90% of traders still find it very difficult to succeed in this game. Well, it all boils down to their psychology and mindset. Trust me when I say this, in your path to profitability, even if you have all the boxes checked, you might have the best strategy ever created, but you'll still find it difficult to succeed in this game if you don't have a strong psychology. Once you learn to conquer the mind, you learn to conquer the financial markets as well. I'm sure you've heard of the saying that business is 80% mindset and 20% skills, and it equally applies to trading as well. Do you really think drawing a few boxes and doing our technical analysis is really that hard? No, it's not. Anyone can learn technical analysis in just a few days. But the thing that holds them back from getting to the next level is they themselves and their poor psychology. Emotions like fear and greed will always be present with you while trading. Sometimes you might have your technical analysis indicating you to go for a long trade, but you might be fearful of the fact that what if you lose money on this trade? So you fear pulling the trigger and later on the market goes on in your favor. Whose mistake was that? Was it the technical analysis error or was it your own error? Sometimes you might be on a trade where you're on a winning trade and the price has already hit your take profit, but you want to squeeze out more profits from that trade being greedy. Now, again, this problem does not happen to beginners only. Traders, experienced traders like me as well, still face these problems. Like, example, a few days ago, I had a trade which was running at $2,000 profit, but I wanted it to go up until $5,000 profit. And guess what? Later, the markets reversed and stopped me out at breaking. As emotional creatures, we are always susceptible to emotional trading errors. It's completely fine. But the thing that differentiates the winners from the losers is that they learn from their mistakes and try not to make them again, while the losers keep repeating the same mistake again and again and again. But I would not want to leave you clueless about how you could improve your psychology. So let's talk about a few actionable tips that you can start implementing right after this video, which can help you to improve your psychology a lot. The very first tip that I would like to give you is to reduce your screen time. By reducing your screen time, I do not mean to reduce your learning time. You still need to put in the hours to learn this graph, but by reducing your screen time, I mean reducing the actual amount of hours that you put in while trading. So if we have a look at this graph over here, our trading performance diminishes by the number of hours we put in. So it's not like a typical job where the more hours you put in, the more money you make. In trading, you get paid for the quality decisions you make. So if you're stuck in the charts for 24/7, you deplete your mental capital, which hinders your ability to make rational decisions, which ultimately affects your trading performance. So what I would recommend you to do is set a max number of trades per day and max number of trades per week. Once you hit these max number of trades per day, just close your laptop and go about your day. Even if you find a trade, just don't take the trade. This tip alone can protect you from so many losing streaks because you have a set number of trades that you take per day, which will automatically let your mind be laser focused and find that high probability trade, because your mind knows that once I hit this certain number, I'm not allowed to take any more trades. So your mind will automatically be laser focused. And once you hit that number, let's say you have maximum 2 number of trades per day. Let's say both of them were losses. Now, this is where other people will get emotional about it and start to revenge trade. But if you have a rule that says that once I hit 2 trades in a day, no matter win or loss, I close my laptop, this tip alone can help you to protect yourself from so many losing streaks and your blown accounts. Another thing that I could recommend to you is to start journaling your trades. This tool single-handedly transformed my trading career. What gets measured gets improved. So if you don't measure your trading performance, how do you expect to improve? It doesn't work that way. There are plenty of softwares available in the market, but the one that I use is Notion. It's completely free. You can search for Notion templates, trading templates, and you'll get plenty of them on YouTube. Just copy one and start using these templates to journal your trades. I'm grateful that I started journaling my trades 2 years back, and my trading performance has improved ever since then, and I would recommend you to do the same. Remember, it's a journey of constant iteration, and just because you watch this video does not make you a profitable trader, but as long as you keep learning and getting more experience, eventually those profits will come. The only way to succeed is try, fail, learn, and try differently. So keep improving, keep learning, and I'm sure one day you will get there. Check the links in the description to join my free trading round channel, and also shoot me a follow on X, as I'm mostly active on these two platforms. And I will also pin the video on the strategy video. So if you want to have a look at that, you can look into that as well. And I will catch you guys in the next video. Till then, take care. Bye-bye.